Hi, I'm Jimmy. In this video, we're going to look quickly at the fast-growing tech company known as FSLY, ticker symbol FSLY. So first, we're going to look quickly at FSLY's business, what they do, what makes them unique. Then we're going to look at some recent news that have come out about an acquisition that they're making. And then we're going to see if we can come up with a fair value for FSLY stock. Okay, so let's jump right in. So what does FSLY do? Well, basically, they're behind the scenes, and what they do is they make websites or apps or user systems work better and faster and more reliably. Now, they're already working with a ton of online companies and they have a big presence, although they are right now a relatively small company from a revenue perspective. They're working with companies like Microsoft, Slack, the New York Times, Vimeo, Pinterest, the list goes on. And these companies, or these types of customers that they have, are ultimately driving much of their revenue. They call these enterprise customers. Okay, so clearly at least a few companies are using FSLY. So here's how we can visualize, or at least how I visualize what FSLY does. As I was researching the company, I was trying to truly understand what they're doing. So nowadays, we can, let's say we have our phone or a computer, whatever we have, and we take a picture on our phone, or we send a text, or we add a new contact to our phone, whatever that might be. Well, not only does that save on our phone, but it also saves to the cloud. And I'm sure most of us know that the cloud is really nothing more than a server farm somewhere. The only advantage is that now our phone or computer, whatever, is allowed to connect to it quickly and easily. Okay, simple enough. And broadly speaking, a website would work the very same way. A website would save all of their information, all of their files, images, things like that, on a server farm somewhere. And as we access that for a site like, let's say, YouTube or Amazon, well, we access their servers. But there's a few potential problems with doing it this way. What if the server farm is far away? Let's say the server farm is all the way over in California, and maybe we're trying to access it from Canada or Europe or New York or even Ecuador, somewhere far away from California. Well, outside of how fast our personal connection speed is, our ability to download content or view content is going to be at least partially limited by how far we are from the source. So clearly, the further we are from California, in this case, assuming they're at that server farm, the further we are, well, people right down the road from the California server farm will have a much faster access point than the people over in, let's say, Europe. Now, when I say much faster, just to put that in perspective, we're not talking seconds, we're talking milliseconds. So much faster, take that with a grain of salt. In virtually all cases, we're talking about milliseconds. But still, the concept remains true. The further we are from the source, the longer it will take to get it. So for a business, or even something like a driverless car, well, milliseconds matter. So now this brings us to what FSLY brings to the table. So there's something known as the Content Delivery Network, or CDN for short. And basically, it's when a company like FSLY, well, instead of setting up a giant server farm or a few giant server farms, they essentially set up a ton of little server farms or little clouds. And their goal is to get geographically as close to where the main users are. So the goal is that when a company like YouTube, well, if we would upload content, I upload a new video, well, that video gets automatically spread around the entire FSLY network. So if somebody tries to access it from Australia or New York or California or somewhere in Europe, no matter where they are, ideally there's a local server that FSLY controls. So basically these little clouds allow for everybody to be close to the source, so it makes things much faster. Now, one of the advantages to that is because each server farm or little cloud, however you want to look at it, is much smaller, well, that makes setting up things like firewalls or security or anti-bot software, it makes it much easier to control since you're doing it in isolated instances. Now, if we don't care about how any of that works, we only care about what does FSLY ultimately do. In summary, companies that use them, they try to make their websites more secure, faster, more reliable, they have less downtime, and each individual server, it's tougher for a server to crash if the users are being spread out amongst all different servers. So one advantage that FSLY says that they have over some other people that do this, or some other companies that do similar things, there are a few competitors that do similar things, is I heard the CEO of the company in one of the interviews that I watched on him. He said that Fastly was built by web developers for web developers. So basically, what their niche is that they make coding within their system much easier. So you're able to control things a bit more. You're able to customize the user experience more than you would with some other services. And this is true for everything from image optimization or video streaming or just typical text on a website or in an app. So overall user experience is supposed to be better and faster and more reliable if they use the services that Fastly offers. Okay, so now we have an idea of what they do, and I think that this is a logical switch to an acquisition that Fastly recently announced. So Fastly recently announced the acquisition of a company called Signal Sciences. Now, Signal Sciences specializes in security, and one of their specialties as far as security is concerned is something called API threats. API is short for Application Programming Interfaces. Basically, it makes things more usable for programmers. It allows them to organize the code a bit better. So I'm sure we can all see why this type of acquisition would be very good for a company like Fastly. Fastly was already relatively strong in what their products were offering. If anybody was going to take a shot at them, it would have been in the security part of their offerings. With this acquisition, they're able to patch that hole quite nicely, and the majority of the customers don't really overlap that the two companies had, so they really get introduced to a brand new customer base and can cross-sell them on different products that they have. So in the long run, well, I expect for this to help Fastly grow quite nicely. Okay, now let's shift over to some of the numbers and see if we can come up with a fair value for Fastly stock. And this one is a tricky one because Fastly right now is not profitable. So not profitable companies tend to be much tougher to come up with a real fair value for. Okay, so let's start with revenue. Now, there's a couple things that jump out at us. First, Fastly's only been around for a short period of time, so that makes sense, and they're growing quite nicely. And analysts are expecting for that growth to continue. Analyst estimates are the lines in the green bars. Now, it's not too surprising that growth would be expected to be as high as it is with a young tech company that is sort of on the cutting edge of where things are heading. So I do think that it makes sense that we would see this type of growth. But one other point that I actually found more interesting was gross profit margins. So clearly, if we ignore analyst estimates, well, gross profit margins have been improving each year. They've been going up by about 1% each year. And this is logical because as a company would get larger and they would gain more, let's say, economies of scale, well, in theory, they should be able to develop better, more efficient gross profit margins. But we may notice that analysts have the gross profit margins jumping in 2020 and 2021. And that's at least partially due to the fact that Fastly is acquiring Signal Sciences. Because Signal Sciences has better gross profit margins than Fastly does, so when you combine the two companies, well, you end up with a overall higher gross profit margins for Fastly. And this is great because this should lead to a more profitable company down the road once they get big enough. So overall, this should lead to a higher stock price as well, or at least a higher multiple. They should trade at a naturally higher multiple if they do, in fact, have higher profit margins than, let's say, a company that has in a similar industry, but less profit margins. Okay, now let's try to value the stock. So, like I said, they're not profitable. This is their free cash flow, which makes using discounted free cash flow nearly impossible, since they don't have positive numbers right now. So anything we would do with discounted free cash flow would simply be guessing. So one of the more popular methods of trying to come up with a fair value of a not profitable company would be to use something like enterprise value to EBITDA. EBITDA is short for earnings before interest, taxes, depreciation, and amortization. Now, this is very similar to price to earnings ratio, at least conceptually it's similar, just not as popular. EBITDA is easier to use than earnings per share because there are a lot of companies that aren't profitable, but many companies, dare I say most companies, have positive EBITDA. But here's the real issue as far as Fastly is concerned. So I found a couple competitors. We have Cloudflare, which does not have positive EBITDA. So, like I said, there's no ratio there. That's one of the few examples of where they don't have positive EBITDA, so it doesn't work there. And then we have Akamai. Well, they're really the leader in the CDN space that we talked about before, and they're trading at a way lower multiple than Fastly is right now. So overall, this doesn't do a lot to help us as far as what multiple should we use. What is a fair multiple for Fastly stock? Their competitors are not really helpful from this perspective. Another option is to use enterprise value to revenue. Here, Akamai Technologies has a reasonable 6.3 times revenue, but both Cloudflare and Fastly are so much higher because they have much smaller revenue, and for some reason they're not priced anywhere near where Akamai is. So I'm not sure that this does a good job of helping us come up with a fair value for Fastly stock at all. Now, I do want to point out that I'm doing this video on Fastly because we have a premium membership community for this Learn to Invest channel, and that community votes on the companies that we should analyze. I say that, I hedge what I'm saying, because typically I wouldn't do a video on this type of stock, except for this stock won the most recent poll, or at least it was tied for it. I'll do the other company very soon, but it won the most recent poll. That's why I'm analyzing it. But I hate to say it, I can't really come up with a reasonable fair value for this stock. So broadly speaking, is Fastly worth investing in today? Well, the only way I could possibly justify investing in a company like this at this point is if it was a small speculative position in our portfolio, in our, in theory, well-developed, well-rounded, well-diversified portfolio, and this we wanted to add a small speculative piece. Something like this could make sense. We just have to be prepared for the fact that this stock might not go anywhere, might just sit there for a long time, even if the company keeps growing. It's very possible it moves higher simply because they continue to grow perhaps faster than analysts expect. But I have no reasonable way of predicting how something like that would happen. So for me, on a personal note, I won't be investing in Fastly. As interesting as the company looks, it's simply way too overvalued at this point for me to look at it. Now, another valuation method that we could try is something called the PEG ratio. PEG is short for price to earnings growth. And this one is a bit tricky without positive earnings at this point, but in theory, if you project it out far enough, perhaps it could work. And in that case, at least we would be able to account for the growth that Fastly is expected to have for the next few years. So if you're curious about how to do that valuation method, I actually did a video where I compared Intel to AMD, and we used that ratio to see how it worked and see how the two companies looked compared to each other. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.